Now, joining me for today's coverage, I have Bismarck Urani, the CEO of Financial Derivatives, and Roy Daniels, Head of Africa Trading Desk at Rand Merchant Bank, joins us from Johannesburg. Gentlemen, thank you so much for joining us.
Thank you.
Bismarck, I'd like to start with you and maybe just starting from your views on the inflation number, because clearly that is important to the MPC. We've seen an uptick, and many are suggesting that it's probably going to rise from here. What are your thoughts on inflation, and how will this factor into the MPC's decision today? Inflation
is an output versus money supply measure. In other words, we've seen inflation get to the inflection point based on seasonality, based on a certain amount of liquidity pressure, but more than anything, logistics and distribution costs, because the price of diesel had gone up. Now we are going to begin to see demand pull factors. The moment the minimum wage is paid, both at the federal, state, local government level, and organized private sector adjustments, we think the total of that will come to almost 2 trillion naira, which is about 10% of money supply, M2. If you take 10% as on a range of 100, that is 1% increase, 1.1% increase in inflation, the worst case scenario. So if you add 1.1 to 11.37, you get 12.47% as the downside of inflation. Having said that, if there's an increase in output, increase in productivity, and adjustments to do with the taxes, VAT, benefit taxes, we might mop up some of that liquidity, and therefore you will have a neutral position. But worst case scenario, we're looking at 12.47. Best case scenario, we're looking at about 12%.
Well, so all that said, how does that factor into the MPC's decision for you? Or do you think it has any bearing at all?
It should have a bearing, because
we've just cut. So yeah, we can't conceivably begin to tighten again, can we?
No, you cut the price of money, but you reduce the supply of money. You increase the OMO activity. So a price without supply is not an effective price. So basically, at the end of the day, inflation expectation is what is going to drive, what should drive MPC monetary policy decisions, not historical inflation. Historical inflation is already baked in. What we are saying is that inflation expectations will take into consideration two key factors. One, the minimum wage impact. Two, the securitization of government debt, which has another 2.6 trillion naira. When discounted, you get about maybe 1.8 trillion. So all of that taken into consideration, you will have some adjustments. You need to make some adjustments. I'm not saying that they would increase rates, but don't forget that growth slowed from 2.38 to 2.01. Therefore, there is a need for fiscal catalyst. The fiscal problems are clear and present dangers to Nigeria's macroeconomic stability.
So very quickly, before I go to Roy, what's your forecast for today's meeting? No change?
No change, but I will not be surprised if they cut.
All right, okay. So let's get to Roy. And Roy, clearly as, if you like, representing the foreign investors, your views are very important as well, because the foreign investors tend to really play a very important role in Nigeria's currency markets. And now I'm speaking about the exchange rate in particular. So what are your expectations from this meeting?
Hi, Wally. I cannot disagree with Bismarck's view on inflation. We certainly see it being very sticky. So when we look at that, we don't expect inflation to come any lower from these levels. I mean, certainly an uptick and a move higher based around the sort of growth of costs around the food side. When we look at it from an investor point of view, certainly currency stability is always a big factor that plays a big part in the decision to invest. So that's been stable. The currency's done really well. I mean, is it at the right level? Could it weaken slightly? I think there's room for it to weaken slightly without causing any panic amongst the investors. The yields where they currently are, I mean, we would agree that with Bismarck that the last cut took us a little bit by surprise, but we do allow for the factors of growth. So I don't see any change in the rates. I think, we're looking for the yields to stabilize, tick up a little bit more. I think there's not enough sort of fat in the yield value just yet for investors. They're all investing on the short end of the curve. There's very little activity on the longer end of the curve, and that's where we need to see a little bit more happening further out on the fixed income space. So we agree that with most of the market sentiment out there and the market view that we're unlikely to see a rate cut, but given the growth factor coming at 2%, our research team did a lot of work and they called it right at 2%. So That's probably the only factor that we need to consider for a possible cut in rates, but we think we still maintain unlikely.
All right. Now, we know the MPC is a committee, so it's made of several members. But of course, one key member has just had his tenure extended for another 5 years. I'm speaking of the governor of the central bank. What's your reaction to that extension of his tenure? And in your view, what does that portend for monetary policy moving forward?
I think let me first speak to it from an investor point of view. You know, very welcome news, and you know, offers us stability. We know there's not likely to be any changes in foreign exchange policy. There's not likely to be any policy changes around the activities of the central bank. So those are key factors for us from an investor point of view. So very welcome news. We went through that little bit of uncertainty. We saw a bit of money leaving Nigeria based around, you know, it seems a long time ago now, the elections, followed then by the sort of uncertainty about a new contract for the governor. So very welcome. I think the investors are pleased with that. I think that the governor has delivered to the message, the right message to investors over his past period. So his previous contract, very good on that front. And then, like I say, going forward, you know, it's from an MPC point of view, from a rate point of view, we know it's a monetary policy committee. So he's certainly the deliverer of the news of the committee. The committee makeup itself is not really influenced by himself. So looking at what the committee is likely to do, and him and the governor making the announcement, you know, we think it's in their hands as to what decision they make. But on a whole, his reappointment very well received by the investor market.
All right, Roy, we'll come back to you in a moment. But also joining us today is Bayo Mogore, Chief Dealer at GT Bank. Bayo, thank you so much for stepping in as well. So we'll be interested to get your views on how the market is, the build-up in the market towards this meeting and the big takeaways. Clearly, we continue to see volatility in terms of yields in the fixed income markets. But what for you do you think are the key developments in the market that perhaps could have a bearing on the MPC's decision today?
Okay, yeah, thank you for having me. I think since the last cut, there's been a moderation in fixed income rates, about 20 basis points odd. And FX has remained relatively stable. So there are no, apart from the inflation rate that's probably done an uptick, there are no major negatives to take away. So
all well and good, you expect that the meeting will decide today to keep things as they are?
Well, I think there's a strong likelihood that they might hold things where they are.
Right. Okay, but Bismarck, if I can come back to you, clearly growth is still relatively slow. At 2%, we're way below where we need to be. It's anemic. Right. So, again, there's always that conversation about how the MPC can get involved in stimulating growth. Obviously, one of the easiest ways to do that is to try and bring down interest rates to make it more affordable for the private sector. But clearly, there are also some arguments against that because of the potential impact on the currency and, of course, inflation. But overall, your thoughts on the role of the MPC in trying to drive growth?
No, the MPC is for monetary policy. The monetary policy goals are that of price stability, to some extent, currency stability. It's actually price stability, watching the monetary aggregates. So, but built into that is the anticipated inflation. But like I've told you, even if you add 1.1% to inflation to get to 12.47, it's still within a realm of what we can call the natural rate of inflation if you can get growth up to 4%. But growth at 2.01% and projected growth for Q2 is about 1.9 is still dangerous. Therefore, you need to stimulate. Let's go back and ask ourselves, what happened after the rates came down? There's been no impact. The stock market actually tanked. There's been no increase in credit. The OMO activities actually increased. So you reduce the price of credit, but you reduce the supply of credit. So no impact. Now, are you going to do something? Mind you, the Q1 numbers happened a week after the MPC. So you cannot blame the fact that the rate cut had no impact because only 7 days. We will begin to see the true impact of the rate cut in Q2 numbers. So I would say a gutsy, aggressive MPC will go for another cut rate to complement fiscal policy of growth A conservative, prudent MPC will say, let's leave things as they are, see the full impact of what we did last time in Q2 numbers, and then make a change thereafter. If not, we are in the status quo syndrome again.
Right. Well, Bayo, obviously you are in the markets, and I want to hear your views on any risks to the currency stability if we were to see further rate cuts. From where you sit, what's your view on that point? Because we continue to hear this rhetoric about lower rates could mean more currency weakness. What's your view right now, given where the markets are at today?
I think a lot of variables are coming to the decision by foreign investors to see the market as no longer attractive. You've had stable exchange rates. You have very strong oil price, which supports a fairly stable exchange rate. Yes, there are concerns around the equity market, but the fixed income market yields are fairly attractive on a carry basis. Now, how the unattractiveness depends on how deep the rate cut is. Now, a 200 basis point rate cut is not unlikely, but it seems less likely given the fact that it's too much of a move. A 50 basis point rate cut may not result in any significant currency weakness. All right, so if the CBN today thinks that a 50 basis point rate cut is enough to help further stimulate the economic growth, they might take it. I don't see foreign investors exiting the market just because of that.
All right, let's ask.
I think the 25 basis point is what you should be looking at, if at all, not 50. 25 to complement the 50 that was there before.
But at the last meeting, there was so much talk about it being just
signal,
to a large extent a signal. But he has also confirmed that there was actually a decline in rates as well.
Well, you know, there's a signal on the part of the CBN. Now, the entire market also takes other variables in. So, for example, you had a successful election. So, with the election taking place, the foreign investors saw the market as attractive. One uncertainty for them was the election, and once that one was done, it was a major hindrance. They came into the market, and with a very strong demand for fixed income securities, automatically the rate decline was a result. Now, we've come to a point where we are relatively stable. Exchange is stable. We're not seeing that amount of significant flow of foreign investment anymore. It's more like a steady flow. Whatever outflows you're seeing is dividend season. There are some outflows going out, but it's not an exit.
Right.
It's a normal flow of business.
Let us ask the person speaking to the foreign investors. Of course, Roy, no doubt you interact with many foreign investors. What's the appetite like for Nigeria, given the gradual decline we're seeing in yields in the fixed income markets? Would you agree with Bayo that even if we were to see maybe a 50 basis points decline, the appetite will still remain strong? What's your view on that?
I feel that if we get a rate cut now, and we haven't seen that much interest in the longer end of the curve. So it's all been fairly short end of the curve, a lot of demand in the T-bill market, a lot of currencies come in. I think a rate cut now, we might see some profit taking from some of the offshore investors, take some of their money out, see what happens after that. And then, the yields are now becoming less attractive. You've got a profit opportunity. I know that it's a very liquid market in Nigeria, so there's no problem getting in. And then, if you want to leave the market to exit the financial market there. So I think a rate cut, and that might pull some of those yields a little bit lower, and I think based on that you're going to see some profit taking, because it's unlikely there's going to be a third rate cut. So I think as soon as we cut rates now, that places a certainty in the market, and we're going to then see some exit of funds from Nigeria. The growth factor remains a concern, but at 2%, it's not as bad as some other markets we see. There's still some growth and some latent growth within the Nigerian economy. So we're not too concerned about that, given the whole global environment, the whole sort of financial markets globally. It's not great, but it's not terrible at 2%. So we kind of look at that and say, the market can work its way through that. As Bismarck mentioned, the impact of the previous rate cut still has to filter into the market. Now, do they run the risk of cutting rates again, and they don't see it run through the market, and then be forced into reversing their policy? And I think that would be far more detrimental to the MPC. So I believe that it's probably the time, you've had the 50 cut, to be a little bit more prudent, possibly, as Bismarck mentioned, 25 basis points. But I'm uncertain about the impact 25 will have. So, it's time to see how the market plays out before the decision. But A 50 basis point cut, I feel, could lead us to some profit taking.
All right, Roy, I have to interject and go to the central bank because I do understand that the central bank governor, Godwin Emefiele, is standing by now to read the considerations and decisions of the MPC. So let's now cross over to Abuja.
Hold on. Time to hold on.
All right, I understand that we are not quite ready to cross to the governor. But if I can go back to Roy, and I wanted to get your quick views on this before we go back to Abuja. The currency stability right now, would you describe it as fragile? Do you think it's all about the oil price? Because, as you know, the oil price can be very unpredictable. How are you viewing the stability we're seeing in the currency right now?
So the stability, I think, it is well founded on a good supply of dollars and a good inflow of funds into Nigeria. I don't think it's any concern about. I think we look at the oil price more, the impact that has on reserves and the ability then to service the exiting investors from Nigeria. So we think it's fantastic. I mean, there are many markets out there in sub-Saharan Africa that would love to have the stability that we're seeing in Nigeria. And I think given how stable it has been over the many months now, there's scope for it to weaken slightly without it causing any major concern for the offshore market.
All right, Roy, that is your view. I wonder if everyone on the table agrees with that. So, Bayo, let me pose this scenario to you. So, if we were to see the oil price in one scenario move down to somewhere around $50 per barrel, do you think we will still have the stability we're seeing today? Because there are many that still view that it's still an oil story.
Yes, we cannot take away the oil story. So there will be concerns. And a lot now.
And how would that manifest? People will hold on to their dollars and the foreign investors will flee? I mean, what do you think will happen in that scenario?
A lot of variables will come in. For example, the risk of if people initially, some would want to exit the market. Now, if we're able to meet the demand, if the market is able to meet the demand, exit the market, it reduces the risk for somebody else. But the more, if the market becomes very tight all of a sudden because of just that movement, it heightens the risk for everybody else and it escalates the problem.
All right, let's hear Bismarck's story. Bismarck's view on this very quickly before we go back to Abuja.
I think that the exchange rate is fragile, but if there's a drop, you will see more restrictions and not a movement in the rate. The central bank will intervene to maintain some stability, but there will be greater restrictions and more surveillance around it.
All right, no doubt we'll be hearing more about the MPC's view on the currency.